Okay, we are back. I'm very happy to have on the Goldstein on Gelt show Jonathan Eley, who is the personal finance editor at the Financial Times. Jonathan, real pleasure to have you.
Thank you. It's great.
So one of the issues that's come up a lot, certainly in the world, and we've been discussing it many times on the Goldstein on Gelt show, is the situation that happened in Cyprus, and actually is continuing to happen now. Could you give a little backdrop of what was going on, and then I'd like to follow up?
Sure. I think that it depends how far you want to go back into history, but I mean, Cyprus is a very, very small economy, and it has a very large banking sector in proportion to the rest of its economy. And I think that what happened is that banking sector, for historical and cultural reasons, is very exposed to Greece. Obviously, Cyprus being a Greek-speaking island, mostly. And there was a fear that the bank's exposure to those assets in Greece was getting too large and too dangerous in relation to their capital bases, so they needed to be recapitalized. And Europe has had a lot of problems with bank recapitalizations over the past 4 or 5 years, because they've always seemed to end up with taxpayers having to pay billions and billions of euros. Mm-hmm. So this time the European authorities were very keen to avoid that. And they wanted the pain to be spread among investors and among bondholders. The problem is the Cypriot banks didn't really have that many investors or bondholders. What they had were very, very large deposit bases, so lots of people had saved money into them. So the authorities looked for a way to involve the deposit holders in the restructuring of the banks, and the way they did that was they came up with this plan, out of nowhere it seemed, to introduce a levy on all bank deposits. And the interesting thing about that was there's an insurance scheme that operates across the Eurozone, whereby if you're a depositor and your bank gets into trouble, the first 100,000 euros of assets that you have deposited with them are insured, and you will always get those back. And what the EU initially did was they wanted to introduce a levy on deposits below that 100,000 euro limit. So that would hit even relatively small depositors, ordinary savers like you and me. Mm-hmm. And there was uproar in Cyprus when that was announced. So eventually they backtracked a little bit, and they came up with a plan that hit only depositors with more than 100,000 euros in the banks, which did subsequently pass. But the EU came out of the whole episode very badly, really. It looked like they hadn't thought the proposal through, and it looked like they were hitting ordinary people very hard. So in a sense, they were penalising taxpayers in just the same way as if taxpayers had to bail out the banks in the first place.
Mm-hmm. And how much did they end up taking from the people with over $100,000?
I think it varies, but I believe it was as high as 40%. And the reason they did that, incidentally, was because a lot of the money in Cypriot banks is not actually Cypriot money. A lot of it has come from Russia, mm-hmm. And some of it is suspected is the result of possibly criminal or fraudulent activity. It has a little bit of an unsavoury reputation, whether that's deserved or not, as being a sort of offshore finance centre. And I think that's one reason the EU is very keen to avoid being seen to bail out depositors in these banks.
So why was it that Cyprus was different? What made them be the first bank that wasn't immediately bailed out?
I think that two things really. One is the provenance rather of these deposits, and the fact that a lot of that money was actually from outside the European Union. It wasn't Mr. and Mrs. Kostos putting their normal savings in there. And I think the second thing was the sort of growing anger across Europe at taxpayers' money being used to rescue banks that had taken too many risks and not managed those risks properly. I think that's why they tried to do it a different way. And I think they will learn from the mistakes, and we will probably end up eventually with a better process for managing bank failures.
In the past few years, have we seen anything like this type of levy on deposits elsewhere?
It's not unheard of. There have been levies on deposits before, and in fact, if you're in the US, if you go all the way back to the 1933, FDR Roosevelt made a raid on people's gold holdings, so it's not unknown. I think though in other European countries the practice has been that the state has guaranteed bank deposits first and then worried about how it would pay for that later. And that's certainly what happened in Ireland in 2008. Again, that's a country with a very large banking industry relative to the size of its economy. And they in the dark days of 2008, they issued a proclamation saying that they will stand by all deposits in banks, even those above 100,000 euros. And it rapidly became apparent that the Irish state could no way afford to do that, which is why Ireland ended up having a bailout from the EU and the IMF.
And of course, it doesn't really give a good feeling to people knowing that the banks can take whatever risks they want, and ultimately they'll be bailed out by the governments or the which is the taxpayers in the end. We're talking to Jonathan Eley, who is the personal finance editor at the Financial Times. So, with all of what happened in Cyprus, there are a lot of people who are internationals who open bank accounts around the world, and they do get a sense that there will be safety. But clearly there are some lessons that individuals, the smaller guys, as you said, like you and me, have to learn. What do you think people should take away from this?
I think one of the key things is probably to spread your money around. I mean, sort of diversification is an old investment chestnut, isn't it? We always say don't put all your eggs in one basket, and I think that applies to cash as much as anything else. If you do have large sums of money, it's best to spread them around several institutions so that if one of those institutions were to get into difficulties and there were to be a call on the deposit insurance, you would not be putting all of your money at risk. And you might say, well, under what circumstances might I possibly have, these vast sums of money? And actually, you'd be surprised, if you'd inherited money, if you had sold a property, or if you'd sold a business, it could be that you have a large sum of money on deposit even for a relatively short time. So it is worth thinking about if you do find yourself in that situation.
I think it's a real issue. In the United States, there's the FDIC that covers people for $250,000. And I was speaking to a CFO of an international company, and they had done a round of financing and raised tens of millions of dollars. And they asked, where should they put the money? And because there was no place to really guarantee it, they ended up putting into U.S. Treasuries, feeling that even though they were going to earn basically 0% on the money, at least they didn't have to worry about a bank default.
Yes, that's true. I mean, that's what a lot of big corporates, especially with Treasury departments, do. That they will put their money all over the place, but typically in short-term deposits and things like Treasuries and other government bonds that are very easy to sell in a hurry. So if you need to get that cash back, you can do so. Now, small investors can do a similar sort of thing in the sense that they can put money into short-term money market deposits and cash funds, which fulfill a similar purpose. But the cover for compensation is not as high, at least in the UK, on those types of instruments as it is for cash in a bank.
Mm-hmm. Do you think that all of the volatility we've seen in the overall European Union, as well as in the euro itself, doesn't bode well for the future of the euro as a currency, and that we might actually see a breakup?
I think the risk of a breakup has certainly not gone away, although it's a lot less acute than it was, say, 18 months ago. And I think there are possibly a couple of reasons for that. The single biggest one, of course, is that last August, the head of the European Central Bank, Mario Draghi, told an audience of reporters in London that he would do, quotes, whatever it takes to hold the euro together. Now, so far, the stock and forex markets have not really tested his resolve on that pledge, but there is, of course, the prospect that they may do. And the other thing I think is it's possibly underappreciated outside the eurozone itself, is that the political will to hold the eurozone together is enormous. It is in essence a political creation. It's a Franco-German project to stop Europe going to war again. That's how it was all born, and I think the political will to keep it that way is enormous. I think the single most interesting thing for the eurozone this year will probably be the outcome of the German federal election in September, because I think once the outcome of that is clear, Germany will be able to take set down a very clear line about where their lines in the sand are and what they will and will not agree to. And I think things will become much clearer after that, for better or for worse.
It seems to me, if I were a voter in Germany, that I would, or a taxpayer in Germany, frankly, I would be quite furious that my money was going to bail out countries which I have nothing to do with and I don't benefit from. They talk, so it's true I get to export to them, but I think that for the man on the street in Munich, that doesn't speak to him as much as the fact that some guy in Greece is retired early and Germany has to pay his pension. I would really think there'd be rioting in the streets over that.
I think that's a very good point. I mean, there's opinion poll after opinion poll in Germany that shows exactly that many people in Germany feel that they've lived sensibly and frugally and within their means, and that they're having to sort of cough up greater and greater sums of money to sort of pay what they caricature as lazy Southern Europeans. I think what that misses, though, is the fact that an awful lot of Germans love the euro, and they love the feeling of being in a united Europe where there aren't these terrible wars every 20 years. And I think although there is still a lot of, the opinion polls show that although there is a lot of frustration and annoyance at what they perceive to be transfers of money to feckless countries, there is also, and you don't hear about this as much, there is also a deep desire to be a sort of good European and to stay in a peace-loving continent. And I think that side of the equation gets underreported a bit.
Have they really become such a melting pot in the same way that people from the United States don't really see that much of a difference between someone from New York or New Jersey? But I always kind of felt that people in Europe were quite proud of their heritage and looked at the countries all as very separate countries who just because of the contract have a common currency.
Yes, I think there's a lot of truth to that. I mean, there are a lot of countries in the European Union only joined relatively recently, and even if you look at the ones who have been there from the very start, from the Treaty of Rome in the 1950s, even they're a pretty disparate bunch. I mean, countries like Germany and Italy have only been unified countries for maybe 150, 200 years, and before that they were sort of city-states and dukedoms and so on. And it's often said that Italians, for instance, consider themselves Neapolitans or Romans or Venetians first, Europeans second, and Italians third. So I think, yes, that it's a fair point that within the European Union structure there's a huge variety of different cultures and also different governance models. I mean, Germany, for instance, is a federal country where the states have a great deal of autonomy, whereas somewhere like France is a very centralist country where everything is run from Paris.
Mm-hmm. Okay, well, this has been a fascinating review. We've been talking with Jonathan Eley, who is the personal finance editor at the Financial Times. Jonathan, the last few seconds, just tell me, how can people follow your work and your writing?
Okay, well, as you mentioned, I'm personal finance editor on the Financial Times. I have my own columnist page on ft.com, which is ft.com/seriousmoney. And you can also follow me on Twitter if you so please. And my handle is at Jonathan Eley, which is all one word, and surname is Eley.
Okay, Jonathan, thanks so much for your time.
Thank you.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt show.